Good morning, everybody. Welcome back to Schwab Coaching. It's our Wednesday edition of Trader Talk in today's market. I am your host, Kevin Horner. I am joining you from a freezing cold Denver, Colorado today. We are in minus degrees, but I am pleased to be joined by my friend and fellow coach, Brent Moores, this morning. Good morning, Brent. I understand you guys have a little bit better, a little nicer weather this morning out there in Utah, huh?
Yeah. It's all relative, but I think by pretty much any measure, when you're talking about negative degrees, Kevin, is cold. So we are not there. We're not even close to that. So I'll save my complaints for someone else about the cold weather than you. So
well, you know, Brent, I appreciate the seasons we get out here in Denver, so I don't mind dealing with a little bit of crisp weather from time to time in favor of really the other 300 days of sunshine I get here. So I try not to complain. Everybody say hello to our other friend. Cameron May is managing the chat for us this morning. He'll, of course, get to questions that Brent and I are unable to, but we'll monitor the chat nonetheless for the duration of our show. If you're not already doing so, make sure you're following the three of us on X. You can do that for us. Cameron May CS, Brent Moores CS, and Kevin Horner CS. We'd appreciate that. We are all in the habit of posting for you throughout the week and giving you some data points of note, maybe some charts of interest that traders might be looking at. Good way to get with us outside of the segments, though. It's also a good way for you to communicate with us, so you can drop us questions and comments there on X. Really appreciate that as well. So now, before we get into things, everybody, let's go ahead and check what's happening on our disclosure so that we can dive into the conversation. So as always, remember that our discussion here is exclusively informational and educational. We do not make recommendations nor endorsements for any particular approach to trading in the marketplace. So please bear that in mind. Now, we talk a lot about technical analysis, meaning simply we look at the history of price action and charts, patterns, etc. We discuss the concepts and strategies traders may choose to employ, but we encourage you to think of technical analysis merely as one piece of your decision-making puzzle. We do not encourage you to base decisions exclusively off of technicals. Now, in terms of an agenda, this is our process, everybody. We start broadly. We hit up the major indices. We work our way down through the filter, so to speak. So large cap, small cap, and components of the NASDAQ 100 as well. And then we get into some industry groups, sector action, where you're definitely going to review a few of the notable sectors making moves here today on the heels of our inflation report. In fact, we should make note of that probably off the jump, right, Brent? Because the CPI came in hotter than normal, or hotter than expected, I should say. And that's the reason for our bit of weakness as we kick things off, Brent. We did not make a move as of yet, terribly significant, though. But the market was not pleased to know that inflation is still around, to say the least.
Yeah, there's different times in the market, and sometimes the market is concerned about some things, and sometimes it's concerned about other things. And so right now, and for the past couple of years, inflation has been one of the big concerns in the market, and therefore big numbers in the inflation report, whether they're beats or misses or whatever, are more likely to move the market significantly than others. Whereas if you get, say, a manufacturing report, it can certainly move the market, but it's just not going to have the same effect as inflation does, because inflation, I think we're all kind of still feeling a little bit of a sting of the inflation that we've gotten over the last couple of years, and it's still a concern, and it's a concern going forward. And amongst all the other things, inflation is one of those things that can certainly affect interest rates, and so we see that kind of a big effect from CPI reports such as we had this morning.
That's a really good point, Brent. Obviously, we get a lot of data week to week, month to month, and not all of it is really market moving. But when we're in certain cycles, some of that data is even more important. And as everybody knows, we're all dealing with the hit to our pocketbooks in the inflationary terms. We all feel it, particularly if we just went back 5 years. We would all agree that prices collectively on your day-to-day stuff, every time you go to the grocery store, you see these differences and you feel it. So these reports have a lot of merit in the current market environment. There were certainly times in the past where inflation was not problematic and it wasn't part of the discussion, and maybe we were leaning into other areas for data. So it's another reason why, Brent, talking about it, paying attention on a day-to-day basis, I say it all the time, it might not be the market that you trade, but if you're aware of things on a day-to-day basis, you might be well positioned to make decisions in the moment that you may feel compelled to make based on some of these reports.
Yeah, absolutely. And so that's why it's great to start off the day with Trader Talks probably, and keep informed on watch other webcasts and just be generally informed of the market and be informed of news in general, because it certainly can affect your trading.
It sure can. It sure can. So, Brent, in the short term, let's keep an eye on that 50-day. Our low of the day is pretty much right on it. That's the purple line here, everybody. And if we slipped through the 50-day, could we maybe move our way down to the bottom of this channel that we've created? We certainly could, right? I mean, that's feasible. And the last thing to note is just the action we've seen over the last couple of periods here, Brent. I'm just going to do this. This is my hourly chart. But, when you look at it like this, something that stands out to me, that's a lower high and a lower low. And then this is a lower high. And now we're wondering, do we make a lower low, right, Brent? I mean, here we are. We could hold up here, but any slippage through here could bring us down to the bottom of the channel. Is that a fair assessment?
I think that's a fair assessment. This is a short-term downtrend that we have here on this. And if we're breaking through a support, which we had some lows back on Friday, it looks like, that could have held, but haven't at this point. And even on the, even looking at your pivot points, we've broken through your S2 level there, I think, and that is that's kind of a bearish thing. Now, just because this is a short term, it doesn't mean the longer term trend's changing necessarily, because you have to kind of define your time frames on your trend. But shorter term, this is bearish.
Yeah, we have to at least be aware of it, and then we have to wonder if what's been happening all the while will continue. So, do we get that weakness that brings us to the bottom of the channel? And if we do, is that where bulls step in? Are we looking to continue this particular trend, or are we looking to get outside of it? So for the short run, Brent, the truth is many traders might just watch this short-term channel, whether it's on the hourly chart or the daily, and just decide, you know what, I don't have any feel for this. I'm not going to take any action until I know one way or the other I've got a higher high or a lower low. Maybe that's the action that the trader's waiting on. So you don't have to take any action at this point, in truth. I mean, if you're trying to decide on a larger time frame move, Brent, it probably involves trading above the downtrend line here or below this line here.
Right. Yep. And, you can just kind of tell in the longer term trend. Look at that 200-day moving average. I mean, that's not even close at this point. Hopefully we don't see that soon. And we have a bunch of support levels we could potentially bounce off between now and then. So just because we have this shorter term downtrend doesn't impede a longer term downtrend, but it is shorter. But that's how it starts necessarily, if it is going to ever get there.
Yep. And again, all we like to do here is talk theses, right? We just say, if this happens, then this is potential, or this is more likely to happen with this move. This is more likely to happen with this move. Those probabilities are what may lead you to being more risk on or more risk off. Again, try and think of it from those terms, and maybe that gives you a little bit more comfort, because you're not making black and white decisions. You're making decisions on, all right, this is better today than it was yesterday, therefore I can be more risk on. This is worse than it was yesterday, therefore I need to be more risk off. I need to be more defensive in nature. So that's another way just to give thought to it. Now, we are going to, of course, move over to the NASDAQ here momentarily, but I wanted to address some questions about the yields. Yields are rising today on the heels of this inflationary, the CPI report, Brent. And we had some questions specific to it. Why would yields be rising on such a report today? Can you provide a little context for our viewers there, Brent? I think we could if I had Brent, but it looks like we've got a little bit of a hiccup in Brent's feed. So I'm going to, excuse me, speak to the 10-year briefly here while we get Brent back live on live action from Brent. So what's happening as I see it, everybody, we have a rise in yields today because why? What happens with yields? Why do yields rise? Why do yields fall? It's all tied to the action on the treasury bonds, right? If we are buyers of treasury bonds, then we send yields lower. If we're sellers of treasury bonds, then yields will rise. Today, on the news that inflation is a bit heavier or stickier, if you will, than we were expecting or hoping for, the concern is that the health of the U.S. economy is not where we'd hoped. So what you're getting is a reaction that has traders selling U.S. treasuries, kind of a bearish sentiment tied to the treasury notes and to the health of the U.S. economy. That is sending yields higher. And what I find notable about this is this little thing we drew in last time we talked about the 10-year, everybody, this little head and shoulder top potentially. And one of the things we noted was we were breaking that potential neckline. That's what this red line was defining, for me at least, was the neckline of a head and shoulder pattern. But we quickly got right back above it. And that was really day 3 where we showed a close above the high of the low day in terms of the yield here. And it may have been a little bit of a spike back through the 50-day moving average. And that's how it played out. Looks like I got Brent back, and I'd love to hear what Brent has to say about this.
Okay. All right. So we're looking at the yield. Sorry, I lost you guys for a couple minutes there, but I see we're talking about yields. And I know Carol had a question on why these are going up on the CPI report. One thing I would say is this, kind of from a broader level, interest rates, long-term rates, so we're talking 10-year here, generally have kind of two main drivers of what this longer term rate is. One is economic expectations. Okay, so that's one part of it. And the other is there's kind of an inflation component. Higher inflation is going to be translated into higher cost of money, basically. That's what this is. This is an interest rate. This is the cost of money. And so, because look, if your money is going to degrade at a certain inflation rate, then you're not going to be willing to loan it for a rate that's lower than that inflation rate. So there's necessarily this inflation component in interest rates. That's one reason we're seeing yields jump here. And so I'm sorry I lost a couple minutes of the discussion there, but we did have a nice little bounce, well, a pretty strong bounce here on this. And back above the moving average, that 20-day moving average, which I think we were kind of hoping. I think we all hoped it was going to bounce down off of, but nope, not at this point.
Yeah, not at this point, at least. Now the reaction, it has been. This is a fairly bearish reaction to this underlying seeming belief that that inflation was just going to kind of go away. And it certainly has not, and it has been a bit more persistent. I saw some of our colleagues noting on X here today and in the recent periods that there have been some precursors that inflation might have, that these numbers may come in a little hot. Things like an increase to fuel, for example, fuel cost, diesel fuel in particular, using to transport. And that's kind of a leading indicator on costs rising. So make sure you're again conceiving of all of these things that can be drivers on this. The big thing that stood out here, I believe, is that, like I said, transport services were up month over month 1.8%. I'm getting this from our friend Kevin Gordon with the Schwab Center for Financial Research there. The largest jump in CPI transportation specifically, Brent, since 2022 June. So that is not a wonderful indicator for us, unfortunately. We gotta be aware of that, though, right? Because this is having a real drag on the broader market here this morning.
This certainly can drag the whole market. And Powell's going to be speaking later today. Some of his comments yesterday were a little bit more, I mean, I guess on the hawkish end of things too, Kev, that he said something like, we're in no hurry to, try and lower rates. And you can't just instantly lower rates. It's the market, the Fed doesn't control these longer term rates there
Right.
directly. And so it's a matter of what the market is perceiving. And you can see this Fed watch tool that you have up. This is for the next meeting, March 19th. Yep. And basically 97.5% saying we're standing pat here, which especially after today's report. But I think I didn't notice it yesterday, Kevin, but I don't think it was. Yeah,
it wasn't a big jump on this report, not in the short end of decisioning. If we go further out, though, you're going to see some shifts here. So if we go to June, for example, you'll notice that we jumped pretty significantly in the hold scenario. Yesterday, we were at 50-50 for June to hold steady on rates. Today, it's at 64% to hold steady.
Yeah.
Okay, so they're telling us that they're positioning as though the Fed is not ready to cut or make an alteration to the plan. If we go further, let's say out to September, for example, here's where things get a little bit more like, all right, maybe here is where we have an opportunity for that cut. Again, notice the one-day bump here of about 10 to 12 basis points on the hold steady versus get a cut. So just yesterday, we're still expecting a better likelihood of a cut than we were a hold, and now it's 50-50 hold and cut.
Yeah, and a couple comments on that, Kevin. One, of course, this is not, this is no guarantee what these probabilities. This is just basically looking at what traders are doing for Fed fund futures and how they're trading them. And two, something the Fed has said for a while now, and there is that, they're kind of data dependent and things could change. And they've been true to their word on that, at least, Kevin, in that we certainly have seen them change. I mean, last year initially it was like, we're expecting X number of cuts and whatnot. And it became clear after a while that whatever people's expectations are for the number of cuts probably isn't going to be exactly what comes about in terms of the number of cuts, because it does change. And we're seeing that, and things could affect that. And I hate to bring up the T word, but the whole tariff discussion is kind of affecting this too a little bit here. So this is something that gives us an idea of what's kind of in the market's mind right now. But it's certainly, we don't really know exactly how this year is going to play out as we look further in the year. But what this is saying is the market is starting to shift, at least, towards the idea that we're not going to be seeing a whole lot probably in 2025 in terms of cuts there in the Fed funds rate.
Yeah, it seems like, I mean, first of all, I love that you pointed out that this is merely positioning as to how traders are looking at it. Yeah. There's no guarantee, as you noted. So I appreciate that. But, as a reminder, 2024 leading in, we thought we were going to get 6, 7, 8 cuts, or at least traders are positioning for that. And we got 2. So, good reminder that traders aren't always right. Commonly, traders are wrong. That's the way trading. That's a kind of the mentality of a trader, unfortunately. All right. We knew we needed to get to the rate discussion. There will be some negative impact on rate-sensitive groups. We're going to look at those as well, everybody. Let's move on into the NASDAQ here. Brent off about 0.5%, but still not destroying our trend. We did not make a new high in the short run here, kind of mired in a little bit of a sideways action over the last few weeks here.
Yeah, so I mean, we're still holding that 50-day, and if you look at the longer-term trend over the past year, here you have a year chart, you can see, we're going up left to right, it's going up, but we do see some weakness here in terms of we have some lower highs at this point on this, and so that's not like impending a huge bearish move, but it definitely shows some weakness. And maybe are we a little more sideways now? But longer term we're bullish, but shorter term the less bullish it looks, I would say.
Yeah, feels like we've kind of meandered here, right?
Yeah.
There's not really a lot of a trend. We have a low, and we have a high, and then we've been between them since. So you're looking at almost 2 full months now of just really kind of sideways action. Haven't broken trend, and that's just as important as anything else, that we have not broken down. But if we did break down, Brent, we could find the 200-day moving average here in the NASDAQ, and it's not going to feel good from where we are. I'll point out, if we found it from where we are right now, we'd be looking at about a 7 or 8% pullback to the 200-day moving average, which would feel terrible, but would be totally within reason for a traditionally normal market, Brent. We just really haven't seen those types of drawdowns. They've been really limited. The big one here was the July to August move that we made. But again, that was a buying opportunity, and I'm almost sure that there would be courage and traders bullish who would be, hey, I'd like to step in at the 200-day moving average. It's a spot where we could at least see a pause in any selling.
Yeah, no doubt. And to your point, we've kind of gotten spoiled in a sense in terms of we haven't seen these pullbacks much. You pointed out one exception there, but this is the NASDAQ. So we expect even bigger pullbacks on the NASDAQ. But even 10% pullbacks or something on the S&P 500 is something that you'll typically see, during your typical year. And every few years you see one that's bigger, like a 20% pullback or so. And so on the NASDAQ, which tends to move a little bit more, you'd kind of almost expect a little bit of I'm not calling that this is going to pull back right now, but I'm just saying it certainly wouldn't be a shocker, especially with concerns, if depending on what the economic numbers come out, and that just market valuations as a whole, I guess, would be is a concern that's on the back of some people's minds there.
Yep. So Brent, last thing as it looks on the NASDAQ here, if you're looking for some levels where traders might start acting, everybody, a close below the 50-day could bring you some matching lows. That's around 21,000 even. That's about a 500-point move, about a 400-point move through the 50-day to this level of support. So that's one way to think about it. So, if you didn't like the idea of giving up 400 plus to the downside, some traders would cover a little bit of a position here. And then if we get a bounce here, great. That might be entry for some, but slippage through here could mean this level. Slippage through there could mean the 200-day could hold up earlier. We just don't know. But my point is simple as usual, everybody. Set some levels where you would take action so you know how you want to act when something like that happens. Hopefully we don't see that. We get more continuation instead of breakdown here, but that remains to be seen. Now,
no doubt. One thing I would just add to that is almost like everybody practically. I mean, this may be a slight exaggeration, but it's not a big exaggeration. Almost everybody, when there's a big pullback, says, "Oh," and then the market recovers. In hindsight, they go, "Oh, I wish I bought." Or I should have bought, or I planned to buy when the market got lower, or even before the pullback, they go, I'm going to buy when that market pulls back to a certain level and then bounces. But how often does that actually come to fruition? Not that often is the answer. And so that's one reason why people talk about, keeping your powder dry, I guess, so to speak.
Sure.
Having you have a cash position in your portfolio. Now, I'm not advocating buying at a certain point necessarily. You're going to have to come up with that point on your own. But if you're one of those people that kind of kicks yourself for not buying when it does hit the pullback and hits those signals that you deem are a buying opportunity, the point is you need to make that decision ahead of time, because if you wait for that decision at the time, it's probably not going to be made. So make whatever decision you're making trading ahead of time is the moral of the story there on that.
Great reminder, Brent. And you said it. I often think about it. We all want to be a buyer at a certain level until that move is happening in the moment. Because when it's happening in the moment, everything looks terrible, and you're deciding to be a buyer there because, well, I need to be a buyer there. I told myself I'd be a buyer there, but it's very difficult to take that step and follow through. And sometimes that's the that's the confidence game that the trader needs to play. Sometimes that confidence can be taken through just owning a piece of it. So reminder, I say it all the time, you don't have to be a full position trader. If you feel uncomfortable buying where you said you told yourself to buy, then instead of buying a full position, just buy 10% of what you want. So you can at least experience buying at a level you said you would, and you're building up that history in your mind of, hey, I did it last time and it worked. I've done it before and it worked. Remember, it's not going to work every time. But if you step in, you give yourself an exit strategy, you know, I'm buying here, but if it trades lower than here, I'm moving on. I'm going to take that small loss. I'm going to be wrong frequently for small amounts, right less frequently for larger amounts, though. That's what we're striving for. So remember to try and build that into your process as best you can, everybody. It's very, very difficult, though. I recognize that. Now, Brent, we talked about the shift in yields. We should have known it was going to have a pretty negative impact on the Russell. We are seeing a bit of a breakdown here. Really, the thing that stands out to me is just the continual 2-3 week rejection at the 2320 level and the 50-day moving average. Unfortunately, the 50-day moving average continues that downward ascent now. And we are below the 20-day for 2 solid closes, or 2 days now. And my goodness, today's gap is ugly on this chart.
It is ugly. And, you know, if you recall back to those other charts, how we were saying, hey, look, that 200-day is a long ways away here on those. It's not so far away on the Russell there on that, because, well, look at the trend. I mean, and on the other charts, we were saying, well, we've got a short-term kind of downtrend, but more intermediate, longer term, it's not so much. Well, this one is going back several months. It's a pretty significant pullback. And so this is just a more bearish chart. And this, you know, part of this is struggling. These stocks tend to be a little bit more interest rate sensitive. And so rates staying higher, rates going higher tend to hit these small caps.
They sure do. This looks like a difficult spot. I have all these levels of potential support, but the truth is, Brent, ultimately the 200-day is more likely to be coming into play now than it was, say, 3 days ago. So unfortunately, we at least have to give some consideration to that. Could it be a gap low in here, something like this at around 2220 instead of the 200-day? It's possible, you know, but it's just as possible we see the 200. So, you know, this looks more defensive in nature right now. Our hope, of course, is that we remain in the longer trend, though, and that the 200 does give us actual support if and when we get there. All right, how about the semis this morning off 0.75%? Not a lot to talk about here, Brent, other than maybe the short-term detail. We know we've been in a consolidation mode and really not trending, but I can't help but pay attention to the rejections we've been having at this confluence of all the major moving averages.
Yeah, we have. And that level right there is about midway in the channel, I guess I would say. So, you know, sometimes you have kind of a major resistance. And when you're going sideways, when you have a channel, sideways channel, you kind of have a major resistance level, and that would be up above 5,300 there. You have kind of a major support level, that's around the 4,800 level. But sometimes it'll pick up kind of mid-range a secondary resistance. And we may have that right here, given the bounce that we just recently had on there, and a few other touches along the way in there as well. So now if we were to break back above there, then that major resistance up above 5,300 still is in play on that. But in the near term, that's a pretty significant. Not only did we bounce about a week ago, but we have all 3 of our moving averages right there. And so when you have this confluence of different resistance levels, or support levels for that matter, that tends to strengthen the conviction that those resistance levels are likely to hold there.
Yep. I can't help it but make note of that continued action and the reminder. What confluence like that implies, Brent? It tells us that traders in a short-term window like the 20-day short term like the 50-day or longer term like the 200, they're all seeing the same thing that we are, and that is resistance at that same 51.25 level. And that tells us that traders in multiple time frames are feeling uncertain about the semis, and that can shift a bit here, especially if we traded under 4,800 with any conviction. So, we have to be aware of that because we know the importance of the semis to the health of our own economy here. Brent, you and I talked a little bit pre-show about wanting to review some of these sectors because there's been some big moves. And, yesterday afternoon, I was feeling optimistic about real estate and utilities because we'd been watching yields fall, and both utilities and real estate had been rallying a little bit. Well, today's news may be putting a little bit of pressure on both utilities and real estate, but they're improving nonetheless. And I'm wondering, Brent, if that tells us that maybe even though we've got a short-term spike in rates, potentially the expectation could be for rates to essentially retreat from where they are. But what are your thoughts?
I think that's the most likely explanation, Kevin, because these two sectors tend to be more interest rate sensitive sectors. Utilities tend to be fairly heavily debt financed. Real estate, if you just think of like mortgage rates and whatnot, that's a big consideration in real estate. And so it's, these, and you can see that, there's a move down in these today, and I think directly from the interest rate. But why are they going up in general? Well, I think the longer view. I mean, we were looking earlier at that FedWatch tool, and we're saying, well, maybe there'll be a cut or two in this year. Well, so that's not super optimistic for everyone who wants to see, but it is the general direction. The general direction is, I think, a feeling that rates are more likely than not to go down throughout the year, even if it's not going to be nearly as quickly as anybody hopes here at this point, I guess.
I think that's probably the case. The fact that stands out to me here, Brent, the long end of things, the improvement, nice upward sloping 200-day moving average that kind of tells us that it's a healthy trend here. We're off the peaks, but we're in kind of a full-on settle out the move mode, right? I mean, just as an example, you go back a year, and then the rally we saw here to the peak was pretty tremendous, everybody. I mean, you're looking at, let's see here on the middle. There we go. I can put my note on there. There it is, up 40% in that window, Brent. So that was about a 10-month rally that put utilities up 40%. You're going to get a little bit of sideways action and consolidation thereafter. Real estate made a similar move. Very big correctional move here, though, Brent. Notice we've got the 20-day upward sloping aggressively. Took out the 200 in the process of taking out the 50. This one looks a little bit more intriguing, doesn't it? As a reminder, though, this is not home construction, consumers like you and me buying a house. This is more likely tied to real estate trusts than anything else, commercial detail, right?
Yeah, it sure is. And this is a more challenging chart. I mean, we were bullish, then we had the huge quick move down, more or less regaining it from where is it, mid early December. Well, I guess late beginning of the year we hit a low. But since then we've had some higher highs, higher lows, and today's a little bit of a setback, but it's not a lower low here. It's kind of a low that the low right there where you're pointing would be the next low for it to break. If it breaks below that, that would be a much more bearish situation for this. Of course, to get below there, you'd be breaking your moving averages. But to this point, it's actually not that concerning to move because we have our moving averages in place. And so, we'll see how the market reacts after today's news is, fully digested here, I guess.
I think the key for real estate for the particular sector is just to watch this trend line. If you're under the 200-day, boy, this looks a lot different. that could stand out. So, I mean, keep an eye on this one. It looks a lot. I still think that this, as a sector, looks a lot different than, say, the home building or the new home construction. Let me give you a quick look on that, everybody. This is the total U.S. home construction market, and you can see how today's rate environment is having a negative impact on the builders and construction in general, Brent. What a real difficult move here.
Yeah, and that's a pretty significant support level you had that looks like we're breaking today on that. And we'll see if we get a strong bounce coming up after that. But that's a pretty strong break.
Wow, that stands out. So could this be an implication that, yeah, rates are up, yields are higher, brand new home buyers are going to see more pressure from the standpoint of a higher rate, which means obviously a larger payment, less dollars available, of course. This is a significant development if that is a weekly close under that 100-week moving average, everybody. We've not seen that since December of 22. We haven't been below the 100-week on this, Brent. Is that significant? It sure could be.
Yeah, it sure could be. That's a long-term moving average, but it is... that's showing just how far we've come down. I mean, just look back, I don't know how many weeks ago that was, maybe 20 weeks, where our high of 29,000 on that index there. That's like a 30% drop. What is that, Kevin? That's
right here, it's giving us just about 28% off the peak. And that peak was October. So you're looking at about 4 months. Yeah.
Yeah. So, I mean, this is just a small segment of the market, but, earlier we were talking about 10% drops and we haven't seen many of those, and how big 20% drops. Here's almost a 28% drop. That's a doozy.
Yeah, remember everybody, you're going to need to do your due diligence if you're looking for individual equities in these spaces and how they correlate to other maybe proxies for home builders. I would encourage you to make sure you're reviewing your breakdown. If you're leading into maybe funds, for example, you want to see the components and the allocation of assets to individual equities there. You'll probably find some similarities among some of the builders in this particular chart, but that stood out to me. I wanted to make sure we spoke about that. There's been some improvement in a couple of areas that were notable. Before we get to, well, actually, let's do that. I'm going to come back to one that I don't like, or one that's been struggling in a second. Let's look at Staples briefly. Staples has been in a pretty good rally mode, Brent. Got us right back to the top of the channel here, but on a breakout, boy, would this be nice, wouldn't it? If we could get through that, nice for the Staples space. But Brent, we shouldn't ignore what that might imply for us, right? Because Staples, that's kind of a defensive nature sector.
Yes, it is. And so when we just, for everybody's sake, when we talk about defensive, we don't mean defense industry. We mean the type of stock that is going to tend to outperform when economic conditions, when the market's not doing as well as a whole. And this is going to be one of the stronger sectors. You often will talk about Staples or healthcare or utilities as more defensive type sectors in that regard. So, yeah, we've seen some short-term strength in Staples, and that's a pretty significant resistance level we have right there. We're not there yet, but in terms of sectors, if you kind of just look at sector performance over the past month, Staples looks like has been actually financials as well has been up there, but one of the top 2 performing sectors out there over the last month.
Yeah, the technical condition here looks to be spot on too, Brent. You had a breakout and some consolidation. You got weakness that took you to test the breakout ledge, and now you're off of it. You're getting, in fact, a really speedy slingshot move, which tells you that the breakdown may have been invalid to begin with, right? Because it bought back so quickly. So that's a pretty notable move. But if you're sitting on your hands, bulls have every reason to continue to do so, because the risk reward is inverted here for bullish traders unless you get a close over 904, 905, which would then allow bulls to set risk much tighter right below the breakout level. Right now, if you're feeling bullish, that's great. But if you don't get a breakout, your risk is down to, the breakout level around here, around 835 again. So that's kind of an inverted risk reward ratio as it stands right now.
It is. So what some traders will do, they'll wait for the breakout to enter.
Mm-hmm.
If you were to get in now, you may consider, and of course stops aren't guaranteed, but you may consider just kind of moving that stop up to one of these tighter type stop situations in anticipation of the breakout. But generally that'd be more of an aggressive approach to trading this sector here.
Now, Brent, would it shock you at all to see that consumer discretionary is breaking down a little bit?
No, it would not.
Would not, right? Because one,
Correct.
we've talked a little bit about it cyclically, but also because we know some of the leaders in this space have been beaten down. Notably, Tesla has been taking it on the chin for the last few days. In fact, the last week plus, it's been more of a kind of a waterfall sell there. But before we look at Tesla, I just thought we could talk briefly about this. We are in day 4 under the 50-day moving average, Brent. We might be bringing the Horner rule to bear here on this one, unfortunately.
Yeah, and so something you said earlier when we were looking at staples was we broke and it subsequently immediately bounced. And we've looked at a lot of support levels today because the market's been selling off. And being at the support level, even breaking it by a little bit, isn't the end of the story. What we then look for is, does it give you a prompt, strong bounce? And this, we'll have to see if the next level, if we get that bounce. But at this point, we didn't get that bounce. When we broke below the moving averages, the 50 and the 20-day moving average, we're looking, I mean, you maybe had a glimmer of hope on that green candle day there, the day after, but it kind of just petered out and we've just subsequently gone out. So we have not seen a swift rejection of that level here at this point. And so, well, there's the next level there. We can see if that acts as a support level.
It's certainly possible. But we gotta make note of the fact that we've got a more significant move, and commonly one of the things that I think traders struggle to get comfy with, Brent, is broken trend lines like a dynamic moving average, a 20-day, a 50-day, etc. Commonly, when you break these, you will find a horizontal support level to provide support in lieu of another moving average. So, being that we've been above the 50-day for as long as we have, going back to August. Here, where we were above both the 20 for a bit, then finally above the 50-day in early September. Being that it's been that long, perhaps this horizontal support ledge can be our hold-up spot right around 1780 or so at one point prior highs. So we got to look at that. And then lastly, let's just peek in on Tesla since I mentioned it. It was perhaps part of the reasoning here. Brent, if you've been defensive on Tesla, you've probably managed yourself appropriately here. But you can see we've been talking about this, Brent. There's been moves into and through the 20-day, but so many tails. Just briefly, can you talk to us about what those tails imply? What does that tell us from a daily chart like this as we try to rally on these intraday moves and just aren't capable of holding them into the closing?
Yeah. So, in addition to whether we're up or down on a particular day, you can look at intraday action, and sometimes you'll see a stock that will test a higher level, and that'll be the top of the tail or the shadow or the wick of the candle, so to speak, but it can't stay up there. And by the end of the day, we end up towards the bottom part of the day. That's kind of a bearish sign. And the inverse is true, and we've talked about this in the past, Kevin, where sometimes midday, things aren't looking good, but by the end of the day, it ends up, and we test lower levels. And if we're trying to test a support level and we see that where the shadow of the candle goes down deep and we end up closing above that, that's great. But the inverse is true. When you see these high tails, but we close near the bottom of the day, it just is a bearish sentiment all along. And we've seen that. And there's just not much that's bullish on this right now.
There really isn't. You're thinking about maybe a bounce maneuver. If yesterday was the low, if we could trade through the high of yesterday, then maybe we've got a rally. But you got to be trading it, from a counter trend standpoint. meaning very speedily, if that's what you think is happening here, because the recent trend has clearly been down. And so bounces into the downtrend line have been sold, and that might continue. We don't know, of course. At some point that'll stop, but only until it stops can you continue to believe that the trend that's in play will continue. I mean, there's no other way to look at it, unfortunately. So rough spot there on Tesla. We're going to have to wrap it up there. Kind of a rough open to the day today on the heels of CPI, but we hope that today's conversation has done a bit to help you kind of weather the storm a little bit. As always, Brent, love having you on a Wednesday, man. Thanks for sharing so many of your thoughts and insights with our viewers today.
Hey, thanks for having me on, Kevin. Just a reminder, there is a survey link in the chat, everybody. So we do appreciate your feedback on that. If you want to tell us what you like, what you don't like, we're happy to, we're all ears, so to speak here. But everybody have a great rest of your day.
Yeah, that's the truth, Brent. Thank you. And we do get those details. They come directly to us, and we appreciate all your comments. So fill that out if you can. Follow us on X. Hit that thumbs up button for us down below. And keep it tuned right here to the Schwab YouTube coaching channel. We look forward to seeing you all again real soon.